you for watching the 2020 Investment Summit. I'm your host, Lance Roberts, and coming up next is Teddy Vallee, head of Pervalle Global Management. Teddy, welcome back to the show. Appreciate it very much. Man, we have a lot of stuff to talk about. The Federal Reserve has basically thrown the kitchen sink at the markets here, going all the way from doing QE and cutting rates to zero just last week to this week actually moving in to buy corporate bonds and corporate bond ETFs. Everything possible to try to liquefy the markets, yet people don't seem to be aware that there's an actual credit crisis of rather massive proportions going on right now, because this is more than just a coronavirus economic shutdown and a global supply shock from that issue, and also an oil shock. There's actually a credit shock going on here. What are your thoughts about where the Fed is right now and what they're doing?
So I think the Fed is moving in the right direction with a lot of the measures they've put in place. Like you saw last week, the Treasury market was not functioning correctly, and if you don't have the Treasury curve essentially pricing, then you can't price anything else. So luckily, a lot of the measures that they put in place have aided the Treasury market, and we're seeing a little more better functioning currently. But the big thing that we're focused on is almost outside of the Fed. It's the government's response to a lot of the small businesses. So the work that we've been doing over the past, call it week or so, is really digging into the numbers on the small business side of things. Mm-hmm. Right now, there was a study that was done by JP Morgan, I think about 2 years ago, that analyzed 600,000 of their businesses on their Chase banking platform, 450 million transactions. And essentially what it showed is that the average small business has about $12,000 roughly of cash on hand. Mm-hmm. They have about $381 of inflows per day and about $374 of outflows. So what we've done is we've essentially modeled with the alternative data that's out there on the small businesses what this looks like and how long these businesses are going to have enough cash to stay in business. So right now, the data that we're looking at has small business sales across all of the U.S. down 39%. So down 39% really is starting to strain cash flows. And we've said, okay, if they keep their whole cost base and we assume that 39% stays flat for the next 6 months, when are they going to run out of cash? Assuming that they have their current cost base. So they're going to run out of cash on May 15th. So this is the U.S. small business, which employs 47% of the workforce, which is about 79 million jobs. Mm-hmm. Will run out of cash if there's not enough capital injected into these guys. So to your point about a credit crunch, I think this is the real credit crunch that no one's really paying attention to. Now, if they do start laying off employees, they lay off 20% of their workforce, for example, they're going to last till May 23rd. And if they cut off half of their labor force, they'll last till June 15th. So what's happening now is, unless the government either comes in with the Fed or addresses this directly, there's going to be monster layoffs. And our biggest fear is that if you have these layoffs and then you have a cure, these businesses will then be shut down and won't be able to reopen and rehire the people back, making the pickup or the next leg hire very, very difficult. Mm-hmm. So the current policies that have been addressed are not enough at all. They have about $350 billion segregated to small business loans. The issue with small business loans is that it takes a significant amount of time to actually get the capital, and we don't have the time in terms of the number of days with the cash balances currently that are being depleted. So a proposal or a thought that we had would be to inject capital via the financial fintech infrastructure that could go through PayPal, Intuit, Visa, MasterCard, where the pipes are already set up, that you could get these businesses capital quickly and give them just basically operational cash to keep them alive, so that when this is over, which it will be over, they're still up and running and they're able to rehire back the employees that they laid off. If that's not addressed, then the credit crunch that you were mentioning is going to be, so bad that it would be very even hard to sort of put numbers to or think about.
When you're talking about what the Fed's doing, the Fed's talking about expanding their balance sheet to $10 trillion. That functions for the financial markets, that functions for the banks, the hedge funds, the guys that play in that area. It doesn't really help much the small business owner. And to your point, that is a very large component of employment in the country. And these are businesses. These are the businesses you use most often, right? These are your nail salons, your local gas station, your local restaurants. There's going to be a massive destruction of that business environment across the economy, which, to your point, will greatly slow any type of economic recovery we might get.
Absolutely. And this goes back to a point that I think we made last time we were on your show, that the U.S. is probably not going to be a place where you want to invest going forward, and some of the return profiles are much better outside of the U.S. So, if we don't get this figured out, it's going to be a problem for U.S. growth for a long time, and the social unrest that will probably happen within the U.S. is not great. Now, if you look outside of the world, China, for example, was able to contain it pretty quickly based on just the nature of their state, which has now led to some positive numbers, or numbers trending back into the levels that they were prior to the outbreak. So that to us is favorable. That's a positive out of all of this, that it will sort of end, and they will find a cure. But the issue is, in that interim period, China was able to keep everything together. The U.S. right now, as it stands, doesn't look like it's going to be able to keep things together unless the government or the Fed addresses the small business problem. Doesn't have any, like the Carnival, what they're doing with Carnival, payroll tax cuts, all that stuff's irrelevant. No one's focusing right now on the small businesses of the U.S., which are the lifeblood, essentially, of the economy. This is just 0 to 50 employees. If you move up to 500 employees, the mid-sized businesses, that grows to about 70% of the whole workforce. So this is the lifeblood, and you really need to pay attention to this. The government, if this gets worse and the government doesn't address it, that's a very big problem, which means the U.S. forward returns are going to be very poor, and the capital is going to flow outside of the U.S. to other markets where things aren't sort of falling apart, which is very negative for the dollar in the long term. So last time I think I mentioned that forward returns based on a few of our models for the U.S. were 0 for the next 10 years. This to us really solidifies that view, and also the buyback thing is now front and center across politicians. Buybacks, which have been the primary bid for U.S. equities, are likely going to be reduced significantly. And if you have a significant reduction in buybacks, that means earnings are going to go down, just based on the nature of pulling shares out, which drives earnings higher, and also the bid's going to go away, which means that forward returns are likely going to be pretty poor.
Where we are at the time that we're talking right now, the government is talking about doing a bailout. Now they're kind of in a tug of war between the Senate form of the bill and the Democrats' House bill, which they both want to try to get money to the markets, but two different approaches. One of the initial approaches was again kind of a bailout for corporations. Of course, this really kind of flies in the face of what's happened over the last few years. Bailing out cruise lines and airlines and other companies that have spent years buying back their own shares and have now gotten themselves into this problem. They're now running to the government for a bailout. Small businesses didn't buy back their shares for years. They don't have access to go run to the government for a bailout. And to your point, they're not the ones that are in line right now to get bailed out by the government. Yes, we may send some checks to individuals for a couple of months. That's not really going to help the problem over the course of the next few years.
That's absolutely correct. If you have, if you're making $40,000 a year and you've just been laid off and the government sends you $1,000, you're still $39,000 in the hole. So for the small businesses, this is crucial that they address this problem. So where we stand from our view right here is, look, the equities are down a lot, sure. If they address the problem, then there might be some value, maybe in the U.S. in certain sectors, likely outside of the U.S. But if they don't address the problem, the S&P could fall significantly further.
It's interesting. We've had the fastest rate of decline in the S&P than any other bear market in history, even faster than what we saw in 1929. Now, not near the depth of what we saw in 1929, but faster in terms of going through this. Now, there's a current belief here because of the Fed and what they're doing, and now the government trying to bail out, kind of the economy itself through some fiscal stimulus, that the bear market's now over. And, this is we're going to kind of be back on track, but, we haven't really reversed the valuation issue that we had coming into this. We may have resolved some of the credit issue, but I'm not sure that we've resolved a lot of the credit and leverage in the markets that existed prior to this. And with what you're talking about, if we don't actually bail out, the 70% of employment at the bottom end of the country that doesn't participate really in the markets and what we've seen here, that, this bear market may still be well entrenched here over the next, several months, several quarters.
Right now, our view is that the high that you saw is probably the high for the next 10 years. There's going to be times where equities are going to go up, 30%, down 20%, up 30%, but that's likely the high that we've seen for the next 10 years for U.S. equities. Even if they address the problem, to your point, there's been so much, you've had 10 years of this where they've constantly come in and suppressed market signals. For example, this is from my favorite trader, Stan Druckenmiller, put out this story a little while ago where the ECB mattress firm, I'm not sure if you heard of it, was essentially the credit markets were pricing the bonds pretty fairly. And if you looked at the numbers were showing that they were having a very difficult time. Now, it turns out that they filed for bankruptcy and the bonds traded down significantly. And we come to find out that the reason that the bonds were trading so well is that the ECB was literally buying the bonds. So because of all this craziness that's happened within the central banks, they've completely mispriced credit risk. And this was a point that we were talking about in November, where credit spreads were not following any of the economic data at all. So with it, I don't know, it's been, a month, right? So a month is not enough to cleanse the system of 10 years of very, very poor allocations of capital and probably a lot of malpractice on some of these financial products that we just haven't seen yet. So to say, assume that we solve the small business problem, that's done. There's still going to be significant amount of losses that we are not aware of that come via the credit sector, via certain businesses. So it's difficult to say, okay, this is the time to now get back in. I think maybe this is the low, but we're going to go up 10% and then down another 10%. It's going to be very choppy. The risk reward profile right now does not make a lot of sense to put a lot of capital into equities. It's about preservation of capital right now, and it's about looking for the best opportunities, the best risk rewards. And right now, equities do not seem like they're in that camp.
We're talking with Teddy Vallee, PervalleGlobal.com, and founder and CIO of Pervalle Global. So we've talked a little bit about the markets having a kind of choppy, maybe flattish rate of return over the course of the next decade. But in the near term, there's a lot of, anxiousness of people that, this is kind of the first big bear market we've seen in a while. And there's a lot of people really kind of chomping at the bit to try to buy the bottom, so to speak. Normally bear markets don't end on optimism. It generally ends in despair where people don't want to buy anything. It's still early. We're 3 weeks at the point of our conversation now. We're about 3 weeks into a bear market, and we haven't seen really the impact to what it's going to happen to earnings for these companies, what's going to happen to the employment numbers, what's going to happen with jobless claims and these type of issues, much less what's going to happen to incomes and credit of consumers, which are 70% of the economy. There's a lot of risk to the stock market because of all the unknowns, and have stocks priced in really what potentially is coming.
The uncertainty factor is very difficult. This is where you basically throw out some scenarios and say, okay, if this happens, then this, if this happens, then that. I think it's probably pretty fair to say that the earnings, the EPS numbers are going to be worse than 2001 in terms of a recession. So that gets you around $140, $150 in earnings power. And you say, okay, well, what's the multiple I want to apply to that? If you do get to the levels that we've seen in 2008, and if you look at some of the most recent claims data from the 15 states that have reported, that's about 692,000 unemployment claims. In 2008, that's 42,000 less on only 15 states than 2008. So the claims numbers that we're likely going to see over the next week or so are going to be significantly higher than 2008. So you say, okay, if this is the scenario that manifests and continues, we'll probably have $110 of earnings power, which is about a 38% decline, similar to 2008. That gives you about $110 of EPS, and then you have to figure out what multiple you want to put on that. You're probably not going to put a 20 multiple on it, which is roughly where we're trading currently. So, if you put a 15 multiple, that's about a 25% discount to where we're currently trading. So I think fair value, assuming that this is like a 2008 scenario, is about 1,500 on the S&P. Now, if things do improve and they address the small businesses, we get a cure, we get people back up and running and working, then we're probably likely fair value roughly. But there's so many unknowns to your point. It's very difficult to say with certainty this is where we're at. This is what we think going forward. It's tough to have conviction, which is why I think position sizing needs to come down. And you really need to wait for some more data to unfold and to have some conviction and the government really coming through and addressing some of these holes before you can make a educated large bet.
Back to the issue of the government addressing the needs for small businesses. You mentioned about passing money through PayPal, through the Visa, MasterCard credit channels, et cetera. But in your view, and if you had your way, if you were in the government drafting the bill right now, how would you actually go about doing that? Because to your point, and a very good point that you made is small business loans are fine, but they take time to process, and they take, right. And of course, when you have, 4 million small businesses all running at one time to the SBA to try to get loans, they're going to be so overwhelmed and backlogged, it's going to drag out the time to even get the loans processed and out to people. So exactly. What would be a better way to do it?
Interesting enough, there's this fintech group that came together, all these companies that I mentioned, including Square, that wrote a letter to Congress and said, look, we have the infrastructure to inject $300 billion tomorrow, where we don't need to have people leave their house. And another issue is that you can't leave. A lot of these regional banks are closed, so it's very difficult to even just go to the place to file the paperwork. So what they've said is we have the capital, or they'll give these companies the capital that then is injected into the small businesses, likely based on their sales numbers, their transactional data. So it'd be a pairing of the government with these institutions to figure out the exact capital that they need to essentially baseline, keep them up and running. They don't need to cover the full cost, but just keep the businesses around. It's pretty unprecedented. It's never happened before. But this virus has never happened before. The economic data that we're seeing is unprecedented, never happened before. So it takes a response that is pretty out there to solve an issue that's never happened, essentially.
Sure. And I guess, we come back to one of my favorite kind of picking points is that, for years we've been running deficits in the country. We've been using, we kept interest rates at zero for almost a decade. We created a massive misallocation of capital over the last decade. And we've warned for the last couple of years saying, look, it's all fine and dandy to run $1 trillion deficit in the middle of an expansion, but what are you going to do when you have a crisis? Well, here we are now. Now we're talking about running potentially a $4 trillion deficit in the U.S., expanding the Fed's balance sheet to $10 trillion, and keeping rates at zero. And the big problem here is there's no end game to this now. There's not going to be a point in a year or two where the Fed goes, okay, we're going to unwind all this and get back to normal.
We're sort of in a new paradigm where this is going to be the norm, and balance sheets are really never going to come down. We're never going to be able to unwind them. Given that scenario, I think gold and Bitcoin, the emergence of Bitcoin during this constant money printing, blowing out of deficits, buying ETFs, buying. It's slow. We've pulled forward a lot of monetary policy that Japan has done over the past couple decades within about 2 weeks. Where you think this would play out over the course of multiple years, it's all been done in about 2 weeks. So if this does get worse, you're probably going to want to really understand Bitcoin, how Bitcoin operates, and likely start thinking about gold.
And of course, you bring up a great point, which is, have we become Japan?
I think we're slowly getting there, and I don't see why. I can't see how we would not trade our move economically towards something of that sort. And here's an example for you: the Japanese banks have been cheap, and everyone says, oh, they're really cheap. And the U.S. banks have been cheap and look cheap because they trade at less than book value. What everyone missed is that rates structurally, as more debt piles onto the system interest rates come down because the productivity of that capital is less. You have to repay that money, which is now not getting repaid, which causes more problems. So rates structurally, from a long-term perspective, are likely going to trend lower. Given that, the valuation of banks globally will all start to trade like Japan at the multiples that they're trading at. So I think after this, the U.S. banking system will not have the same premium that they've had over the rest of the world. So from a valuation perspective on the financial sector, we are very much going towards Japan as an example. And I can't really see how that reverses.
And unfortunately, that also means if we're approaching the Japan's type scenario, and we've written about this in the past, that doesn't play well for the average American and the average retiree that are trying to navigate their way through retirements, or for millennials trying to grow their way into retirement. It's going to become a very, very tough environment economically.
To me, it's a lot is contingent on how they address this small business thing and get people back to work.
But I don't really see them do anything for small business.
No, I mean, the loans that they did in Hurricane Sandy, it took 46 days to process an application of only 80,000 applications for only $800 million. So now you have all of U.S. small business trying to apply at the same time. There's just no way they're going to be able to handle that.
But it seemed to me that the only way you could really do this is kind of what you mentioned here with Square, is saying, almost like they're doing with households, right? We're going to send every household, $1,000 or whatever it is. Take the K1 reports that came in from all the small businesses, or take their tax returns from last year, and send them that amount of money.
Exactly, and they all have that data. All these companies, Intuit, for example, like that does the accounting, has those numbers,
right?
And can literally just be like, okay, boom, this is the number, or the government, here's the tax number, like you're mentioning, and inject the minimum that would cover their operating expenses, just to keep them alive. Because if they're not alive, then we have a huge problem.
That was Teddy Vallee with Pervalle Global, and of course, PervalleGlobal.com. That's PERVALLE Global.com. Be sure and go by his website, check it out. Great research is always there. And Teddy, we always appreciate your time here and love to have you back soon as we continue to kind of navigate through this. And we'll wait and see what happens with the government and what they do for small business.
Great. Thanks, Lance.
Thanks, Teddy. As we continue with our 2020 Investment Summit, coming up next is Jeffrey Marcus from TPA Analytics.